Fractional banking is a banking system in which banks are required to hold only a fraction of their customers' deposits as reserves. This means that banks are allowed to lend out a portion of the deposits they receive while keeping a fraction of the deposits on hand to meet potential withdrawal demands. In a fractional banking system, the reserve requirement is set by the central bank or regulatory authority. The reserve requirement is typically a percentage of the total deposits held by the bank. For example, if the reserve requirement is 10% and a bank receives $1,000 in deposits, it is required to hold $100, 10% of $1,000, as reserves and can lend out the remaining $900. This system allows banks to create new money in the economy through the process of lending. When a bank makes a loan, it creates a new deposit in the borrower's account, effectively increasing the money supply. The borrower can then spend the newly created deposit, and the recipient of those funds can deposit them in another bank, which can in turn lend out a portion of those funds. This process can continue, resulting in the creation of new money in the economy. Fractional banking has advantages and disadvantages. It can stimulate economic growth by increasing the availability of credit, allowing individuals and businesses to invest and spend. However, it also carries the risk of bank runs if depositors demand their funds in large numbers, as banks may not have enough reserves to meet all withdrawal requests simultaneously. To mitigate this risk, central banks often act as lenders of last resort, providing liquidity to banks during times of financial stress. It's important to note that the specifics of fractional banking systems can vary across countries, as different regulatory frameworks and reserve requirements may be in place.